Hello everyone! Today, I'm going to teach you about a very practical technical analysis tool, the moving average, MA. At the same time, I'll also share how to use moving averages to determine a stock's price trend. First of all, you need to understand that stocks are not scientific. They're more like an elusive art. If stocks were truly scientific and logical, then a company with good performance and high profits should see its stock price rise. Conversely, a company with poor performance and low profits should see its stock price fall. However, in reality, what we see is absolutely not so straightforward. Many bad company stock prices can soar to the skies. Many good company stock prices can fall endlessly. Precisely because, in reality, stock price may not move in sync with company value in real time. We, as investors, should learn to understand the movement of stock prices to know whether a stock is currently in an upward trend or a downward trend. Only in this way can we find relatively safer entry points, thus improving the efficiency of our capital and reducing the chance of being trapped. In technical analysis, the most commonly used tool for determining a stock's trend is the moving average. Next, I'll share with you the theory and practical use of moving average. In general, we abbreviate moving average as MA. It uses statistical analysis to take the closing prices of a stock over a certain period, average them, and then connect the averages with a curve. This forms the moving average. This theory may be hard to absorb, so let me try to explain it in a simpler way. You all know a line is made up of many points, right? Now you see on the chart, we're using an MA5 moving average. The line you're seeing is also made up of many points connected together. So where do these points come from? How are they calculated? Take MA5 for example. It takes today's closing price plus the previous 4 days' closing prices, then divides the total by 5 to get a value. Suppose the value falls here, that's the position of the point for that day. By analogy, every day's closing price plus the previous 4 days' closing prices divided gives you a value, which gives you a point. Once you connect these points one by one, you get the MA5 moving average. Understanding the arithmetic logic behind MA, you can now see that MA actually takes the closing prices of a specified number of days, sums them, and averages them. Therefore, what this line really tells us is the average cost paid by market buyers for this stock over that specified period. Now, let's use MA30 as an example. When you see this line, you can think of it as the average cost of all buyers who bought this stock in the past 30 days. So once the price falls below this moving average, it also means it has fallen below the average cost of all buyers in the past 30 days. This is a warning sign, because it may trigger stop-loss exits from investors. If it then falls below MA60, it means the price is below the average cost of all buyers over the past 60 days. If it then falls below MA200, it means the price is already below the average cost of all buyers over the past 200 days, which means many people are losing money. By analogy, you'll understand that each time the price breaks below a moving average of a certain period, it means buyers in that period are now suffering losses. The more moving averages it breaks below, the more people are losing money, and the higher the chance that even more people will be triggered to stop out. With this concept in mind, you'll understand why many experts say a certain stock's trend has weakened because the price broke below such and such day moving average. The logic behind this statement is, once the price breaks below the moving average of a certain period, it means the price is below the average cost of buyers in that period, which in turn may trigger more stop-loss selling, greatly increasing the chance of continued price decline. In practice, we can use moving average of different periods according to our own needs to determine stock trends. For example, Many experts in financial media like to use MA 200 to determine the trend of a stock. The simplest way of thinking is like this. When the price breaks below or is under the MA 200, it means the stock is in a downtrend. Conversely, when the price breaks above or is above the MA 200, it means the stock is in an uptrend. Using MA 200 is to look at the long-term trend of a stock. If you're a short-term trader, then of course MA 200 is not your main trend analysis tool. You should use shorter period moving average such as MA 10 or MA 20. But regardless of which period you use, the simplest thinking is the same. As long as the price is above a certain period's moving average, the trend for that period is strong. But if the price is below the moving average, the trend for that period is weak. Looking at just one moving average lets us see a potential trend, but in practice, when exactly is the right time for us to enter or exit? This relates to an important moving average concept, the so-called crossovers, including the golden cross and the death cross. Here's a medium 2, long-term moving average combination, MA 50 and MA 200. When the shorter period moving average, MA 50, crosses upward through the longer period moving average, MA 200, this forms the so-called golden cross. This indicates the stock's trend is strengthening with a high chance of entering an upward trend. It can be seen as a buy signal, but if MA 50 crosses downward below MA 200, this forms the so-called death cross. This indicates the stock's trend is weakening with a high chance of entering a downward trend. If you're still holding, you may consider exiting first. If you're thinking of entering, it's better not to at this time. Wait for the trend to strengthen again. Before entering, it's not too late. If you're a complete beginner and don't yet have any technical analysis strategies, then before buying a stock, you can try using the above MA 50 and MA 200 combination to analyze your entry point. For example, check whether a golden cross suitable for entry has appeared, or if a death cross appears. Then don't enter yet. Wait until the trend becomes clearer before acting more safely. If you're doing even shorter-term trades, you can use shorter moving averages to make strategy analysis. For example, MA 10 paired with MA 30, the logic is the same. As long as the shorter period MA 10 breaks above the longer period MA 30, it's the so-called golden cross, suitable for going long. When MA 10 falls below MA 30, it forms a death cross, a signal to exit. Note, MA has no absolutely correct combination or usage. You can analyze with any period of MA. The most important thing is that the combination suits you and can effectively help you see the trend or entry. Exit points. Aside from the concept of crossovers, moving average also have another important function, the concepts of resistance and support. Now, I'm going to share the evolved version of the moving average, the exponential moving average, abbreviated as EMA. Simply put, here's the difference between EMA and MA. For EMA, today's closing price is more important than yesterday's. It doesn't treat all days equally like MA does. Therefore, EMA movement is more sensitive than MA. When the price is above the line, EMA 30 is its support line. Once it breaks down, it means the short-term trend is weakening. I should reduce my position or exit. Conversely, when the price is below the line, EMA 30 is its resistance line. Once the price breaks upward, it means the short-term trend is strengthening. Of course, it doesn't mean you can buy immediately after the breakout. In practice, it's not that simple. I will also use other technical tools to find more reliable entry points. For me, I'd rather miss an opportunity than bottom fish. When the trend is unclear below EMA 30, doing so puts myself at high risk. I'd rather be late and wait until the trend is clear and a buy point appears before entering. I believe truly strong stocks are never afraid of us being late. As always, everything I've shared above, the indicators I use, is only my personal, humble experience. It's not some Sherwin technical analysis method. I'm sharing it only to give beginners a practical reference on using moving average. Before adopting my indicators, beginners should remember to check the charts themselves. Only if you personally confirm EMA 30 has some practical reference value should you use it. Finally, I want to emphasize again, the use of moving average varies from person to person. Everyone can adjust the periods or combine them with other technical tools for comprehensive analysis according to their own experience or knowledge. There's no absolute right or wrong. As long as you think it can effectively improve your investment efficiency, it's fine. All right, that's it for today's lesson. If you found the content helpful, please like, share, and subscribe to my channel, and turn on the little bell next to it so you can get notified of my new videos first. See you in the next video. Bye, everyone.